Something happened in the past week that is causing a lot of stir among investors, and it's causing a lot of worry amongst a lot of people in the finance and economic world. And it heralds back to the 2008 financial crash. And what happened actually could potentially have a big impact on your bank account balance and potentially for the U.S. economy and the global economy as well. And I want to talk about what that is, and I want to talk about what you can potentially do to protect yourself against it. So what essentially happened in the past week is something that's referred to as the federal repo operations. Now, most people have no idea what that means. I didn't either until the past week when I saw it mentioned on CNBC, Fox Business, and Bloomberg. And when I started to read about it, I became very concerned as well. So what the Fed repo operations is, it's essentially a way for the government to make sure the banks are solvent. So let me explain how this works a little bit. Now, the banks on a regular basis, when we deposit money into our checking and savings account, they use that money and magnify it. They basically create new money out of thin air, and they're able to use that newly created money to provide home loans and car loans and student loans to people who are looking to obtain a loan. Now, when the bank does that, they are by law required to maintain a certain percentage of their total assets in reserves. Now, their total assets includes all the money that you and I have deposited in our banking accounts, as well as all the loans that they have out to different people. So they need to keep a certain percentage of those total assets in reserve. And that's done to make sure that they are solvent, that they can operate, and that if you want to go withdraw money out of your banking account, you can do that. So it's really important that our banks are solvent and that they are financially stable. So what happens with really big banks especially is at the end of the day, they provided, new loans throughout the day. They bought new assets, invested in new things, provided new mortgages to people. At the end of the day, they do what's called a reconciliation. They take a look at all of their assets, what they have out there, and then they determine what the reserve needs to be. And quite often with these big banks, what they find is that they need to increase their reserves because they've made new loans. So they need to bring their reserves up to, a higher amount. And normally what happens in that situation is the big banks will talk to other big banks and say, hey, we need a little bit more for our reserves. Can we borrow some money overnight? We'll give it back to you tomorrow. And in return for borrowing money overnight, we're going to give you an asset or some loans or whatever it is as collateral. And the big banks do this on a regular basis. This is a part of normal, healthy banking operations. They work together to cover each other's reserves. Sometimes they have less, sometimes they have more. So they work together to make sure they meet their reserves. Now, a problem comes into the financial system when the banks don't have enough money to essentially cover each other's reserve requirements. In that situation, you get into a problem where the banks can't help each other out and they need to go to the government. So they go to what's called the Federal Repo Desk or the Federal Repo Operations Desk to ask the government for money. Now, when they do that, that's sort of the equivalent of hanging your head in shame and doing the walk of shame and saying, hey, we need money. We couldn't figure this out and we ran into trouble. Now, this hasn't really happened at all since 2008 when we had the financial crash and when Lehman Brothers went bankrupt and a number of other banks went bankrupt and had to close. And it was an event that kicked off the global financial crisis. We had in 2008, there was a lot of public discussion about what was called TARP. It was essentially the bank bailout program that we did. We spent a lot of money to bail out the banks and get our credit system back up and working. Initially, the TARP program authorized $800 billion of assets to be given to the banks in order to make them financially solvent again. Now, laws were passed that basically reduced that $800 billion to less than $500 billion, but it's still a lot of money. $500 billion is a lot of money to anybody. So we haven't really seen the banks have to go back to the government since 2008. And they haven't done that up until last week. Last week, the banks went to the Federal Reserve and said, hey, we need money. And the Federal Reserve gave them money. Now, what is concerning, in addition to the fact that the banks had to go to the Federal Reserve, is the amount of money that the Federal Reserve gave to the banks. Now, back in the bailout, the banks received about $500 billion or $500 billion from the federal government. Now, last week, the amount of money that was given to the banks exceeded that. And the Federal Reserve has committed itself to providing on a daily basis for the next 2 weeks, $75 billion per day in reserve repo operations to give the banks additional liquidity, additional money to make sure they are solvent and that they continue to operate. That's a ton of money. Now, back in 2008, there was a lot of public outcry about the banks getting bailed out by the government. We had a lot of discussions and arguments about it. It was out there on the news. Politicians were involved. It was a springboard for what became the Tea Party movement about, people being frustrated about the banks being bailed out and taxes going up. People were really upset about it. There was a lot of discussion about it, and it was out in public opinion. But last week, what happened with the Federal Reserve's working with the banks, that really was done under the cover of darkness. Nobody knew about it until after the fact. And the fact that the Federal Reserve gave the banks essentially the same or more money that they gave them in 2008 without actually opening it up to public discussion is extremely concerning. And this has been a topic of great discussion in the investor community and among the finance community over the past couple of days, because it could signal a potential new credit crisis, new banking crisis that could potentially kick off a U.S. recession and a global recession or global depression of some kind. Now, in addition to this concerning news, there are obviously other things that investors and the general public is worried about in terms of an upcoming recession. There are a lot of indicators out there, with the tariff war, the inverted yield curve, high debt levels that we haven't seen before. There are a lot of things that are worrying a lot of people. So this latest thing with the Federal Reserve helping to bail out the banks is extremely concerning, because it harkens back to the 2008 period where the financial crisis really kicked off. People don't want to see that type of credit crisis again in our economy. Now, those big macro U.S. things we can't really control. As individuals, we can't do anything about them except learn about them and try to determine how we should change our actions or how we should protect ourselves against potential problems in the banking sector or with regards to the overall economy. Now, a couple things that I think are important that you could do with your personal finances and your personal bank accounts that could protect you against potential credit risks and bank failure risk in the future if we do see a problem is two main different things. Now, the first thing that you can do, and I think is a wise step for everyone to take, is essentially split your money across multiple banks. So if you have your checking account and your saving account right now in one bank, you are basically putting all of your money at risk in one bank if there's a bank failure. Now, most people don't think about bank failures affecting U.S. bank account holders, but there is a case for losing money in the U.S. banking system. What most people don't realize is that after the 2008 credit crisis, the laws and regulations were changed on the book. So previously, when a bank failed, the government essentially bailed out the depositors. Everybody who had a checking and savings account, they were covered. Their deposits were covered. They didn't lose money when a bank failed. After 2008, they changed the laws, the regulations, the rules to say that banks, if they failed, they said the government might not be able to bail out the depositors and that the banks could perform what are called bail-ins. And bail-ins are essentially a nice way of saying the banks are going to confiscate your money, some of it or potentially all of it, from your banking accounts, your checking accounts, your savings accounts, your CDs, to basically cover their losses. Now, that doesn't seem very fair at all. And that would really make a lot of people angry. But those are the rules, those are the regulations that are out there. So in order to protect yourself and essentially minimize your risk to one single bank failing, you can spread your money across multiple banks. And I think that's a really wise thing to do, especially if you have a significant amount of money that you are saving in the banks. I think it's wise to split your money across multiple bank accounts. The other thing that you can do is put some of your money into smaller local banks and credit unions. So typically when we see from the 2008 financial crisis, we saw a lot of the big national and global banks have financial problems and go under. So these are big banks like U.S. Bank, Wells Fargo, Chase, Citibank, big national and global banks like that. So if you have all your money in the big banks, you, in my opinion, you have your financial assets at greater risk. If you work with smaller local banks to store some or all of your money, I believe that your risk of loss is less. So consider using putting some of your money into smaller accounts or smaller banks and credit unions in your local area. If they're not nationwide, they're usually considered smaller. If they operate in one state, one community, or maybe just 2 or 3 states, they're generally considered smaller banks, smaller credit unions. So those are 2 things that you can do potentially to protect yourself against a potential banking or credit crisis in our system. We don't know if one's going to happen. We don't know when one would happen if it does come, but the signals out there and the things that are happening in the market, especially in regards to this credit crisis and the Federal Reserve having to cover some of the expenses of the banks in the last week in order to keep them solvent, is extremely alarming. It harkens back to 2008. I think it's important to at least pay attention to those events and protect yourself in whatever manner you think is best. Now, it's really unfortunate that most people have no idea about finance, banking, investing in general. We aren't taught those things by our parents in our school. We are basically thrown out into the real world and left to the wolves in terms of having to learn about finance, money, and investing all on our own. I find that extremely frustrating. And I know I went on a personal journey of learning about how to protect myself, how to grow my investments, protect my wealth for the long run using methodologies that very wealthy people do. And it was really frustrating because it took me a long time to find that information. And it frustrated me as well because most people don't know about how to do that. And what I did that I think is very useful, if you're interested in growing your wealth and diversifying your investments across different asset classes that are something different than just the stock market, which is what most people think of when they think of investments, I would encourage you to read my book. It's called Perpetual Wealth. It's available in both ebook and paperback formats on Amazon. So check that out if you're interested. If you like it, please share it with your friends and family because they would probably find that information useful as well. Everybody wants to have a secure financial future. Everyone wants to, prevent themselves from losing money. Everybody wants to have a secure retirement. So I think it's really important that everybody understands that. But in terms of this video, I think it's really important to consider where you're storing your money in the banks and how to reduce your exposure. So again, I think it's wise to split your money across multiple checking and savings accounts across different banks, and also utilize some of the smaller local banks to store some of your money. I hope that helps you. Obviously, I'm not a financial advisor. This is what I do. This is my belief, my opinion. You have to make up your own opinions and make your own decisions when it comes to your personal finances. But at least I hope this information was useful and provides you with some guidance as to what you can do in the future. Make sure to check out my YouTube channel. I share a lot of information about personal growth, success, philosophy, spirituality, and finance on there as well. I've got a broad range of topics that I talk about. Please subscribe to that channel. I'll include a link in the description of this video so you can get there if you don't know where it is. But until next time, take care. Good luck. We'll see you around. Thank you.